The US dollar is quietly slipping, and most Americans have no idea what that really means. While news outlets talk about inflation and interest rates, something far bigger is happening behind the scenes. A weaker dollar is reshaping the entire US stock market. Some companies are about to cash in, big time, while others could lose billions in profit. And here's the secret. If you understand which side your stocks are on, you can ride this shift before the crowd catches on. Stay with me till the end, because I'll reveal 3 insider metrics that professional investors use to predict who wins and who loses when the dollar drops. Most retail investors have never even heard of them. Let's break it down. Why the dollar is weakening. So first, why is the dollar even falling? In simple terms, the Federal Reserve is hinting at future interest rate cuts after years of keeping rates high. Lower rates mean lower returns for people holding dollars, so global investors start moving their money elsewhere. Then there's the U.S. government's massive debt and fiscal pressure. Investors see that and they start losing confidence in the long-term value of the dollar. Add to that rising growth overseas, from Europe to Asia, and you've got a global money shift out of U.S. currency. Result? The dollar index, or DXY, has fallen from its recent highs, showing a drop of roughly 8 to 10% this year. That may sound small, but in the world of global trade, it's huge, and it can instantly turn corporate winners into losers. How a weaker dollar impacts U.S. companies. Here's how it works. When the dollar weakens, it changes the math for every company that earns, spends, or borrows money across borders. There are 4 main effects. Number 1, when U.S. companies earn money overseas, those foreign profits get converted back into dollars. If the dollar is weaker, each euro or yen turns into more U.S. dollars, boosting revenue and profit on paper. Number 2, it makes American goods cheaper for other countries. That means exporters, from tech to industrials, suddenly become more competitive abroad. Number 3, import costs rise. Companies that rely heavily on goods or materials made overseas end up paying more in dollars for the same products. And number 4, commodities like oil, copper, and wheat are priced in dollars. When the dollar drops, those prices usually climb. That's good news for producers, but bad for companies that depend on raw materials. So the big question is, which side of this equation is your favorite stock on? Winners, the stocks that benefit. Let's start with the winners, the companies that could quietly profit from a weaker dollar. First, big tech. Think Apple and Microsoft. Both make a huge portion of their sales outside the United States. Apple sells iPhones in over 100 countries, and Microsoft earns billions from global software contracts. When the dollar weakens, those overseas sales translate into higher U.S. profits. Second, global consumer brands. Companies like Coca-Cola and PepsiCo thrive when the dollar falls. They earn revenue all over the world, and those extra foreign dollars boost their bottom line back home. Third, export-driven industries. Manufacturers like Boeing and heavy equipment makers benefit because their U.S.-priced products become cheaper in foreign markets. That means more sales and better profit margins, at least in theory. And fourth, energy and materials. Firms like ExxonMobil, Chevron, and Freeport-McMoRan often gain because weaker dollars push commodity prices up, and that means more dollars flowing in for the same output. In short, if a company earns money abroad, sells globally, or benefits from rising commodity prices, a weaker dollar is like a silent tailwind. Losers, the stocks that could struggle. Now let's flip the coin. Who gets hurt when the dollar weakens? Retailers and importers. Think Walmart, Target, or big apparel chains. Most of their inventory is sourced overseas. When the dollar drops, those imported goods become more expensive. margins get tighter, and profits shrink. Domestic-only companies, businesses that operate solely in the U.S. with no international revenue, miss out on any currency benefit. They may even see costs rise if inflation ticks up from more expensive imports. And small-cap stocks often take a hit too. Smaller, U.S.-focused companies tend to import materials but sell only to American customers, the worst combination when the dollar weakens. So, while global giants might celebrate, Main Street companies often feel the squeeze. The 3 secret investor metrics. Now, here's what I promised. The 3 secret metrics that professional investors use to separate the real winners from the ticking bombs. Secret number 1, the foreign revenue ratio. This tells you how much of a company's total revenue comes from outside the U.S. If that number is over 40%, the company is positioned to benefit when the dollar weakens. Secret number 2, hedging neutralization. Check if the company hedges its currency risk using forward contracts or options. If they hedge heavily, the currency move may not boost profits. If they hedge lightly, boom, that FX tailwind flows straight into earnings. Secret number 3, import cost exposure. Look at what percentage of their goods or materials are imported. The higher that number, the more vulnerable they are when the dollar weakens. Proof from 2025 data. Let's anchor this with real numbers from 2025. Analysts estimate that for every 10% drop in the US dollar, S&P 500 profits rise roughly 2% overall. That's billions of dollars created just from currency moves. In recent months, PepsiCo reported that foreign exchange tailwinds helped its quarterly earnings beat expectations. Microsoft and Apple both noted stronger reported revenue compared to their constant currency results, a clear FX boost. And across the market, large multinational stocks have outperformed domestic small caps during this dollar decline. It's not speculation, it's happening right now. The final reveal. So here's the truth. The weakening dollar isn't just an economic story. It's a stock market shift happening in real time. Multinationals with global footprints are positioned to win quietly, while domestic importers may face a painful squeeze. But most investors still aren't watching the foreign revenue ratio, the hedging strategy, or the import cost share. Now you are, and that gives you an edge. Here's my final reveal. I've created a full list of 15 U.S. companies with high international revenue and minimal hedging exposure, the ones most likely to benefit if the dollar keeps falling. I'll share that list in my next episode, so make sure to hit subscribe, drop a comment below, and let me know which stock you think stands to win or lose the most. The dollar's moving, but now you know how to move with it.